market and economic commentary. You can follow me intra-week on LinkedIn and on X. LinkedIn is Herb Space Morgan. X is at Herb W. Morgan. The presentation you're seeing and or hearing is prepared by me. It is designed for use by you, whether you are a financial advisor or an individual investor. Regardless of which you are expected to make your own investment decisions. Nothing contained in the presentation is investment, tax, or any other advice. No recommendation for purchase or sale of securities. The views expressed are my views, mine alone. They may differ from the views of CFIA's parent affiliates or other portfolio managers here at the firm. Well, it was a very rough week. As you no doubt are aware, the S&P 500 had a bad year last week, down about 9%, bringing the year-to-date losses to about 13. Mid and small cap stocks, higher elasticity, down about the same, but on a year-to-date basis, down a little bit more. International markets, which had previously held up, really got shellacked as well, and the EFI and the EM index, I had to double check these numbers, both up 1.74% on the year. But when it was Sunday night here, they were all open and trading much lower. So we'll get an update on that. And I no doubt they will be negative here. In my mind, no doubt they will be negative by the end of the day here today. That brings the equity benchmark for most institutional investors. It's the equity benchmark for our portfolios as well. It's the ACWI MSCI All Country World Index, down almost 9% for the year. Fixed income, as you would imagine, caught a bid. Longer dated Treasury index up 3.5%. These lower rates will certainly benefit the U.S. Treasury as it goes to refinance its absolutely Herculean amount of outstanding debt. And high yield, which had really held tough, sold off in sympathy with equities, obviously did much better than equities. High yield, we measure the value based on the spread, the incremental yield above, say, the aggregate bond index. So if the aggregate bond index was up 1% and high yield was down 1.66%, you can see that spread widened out. Probably not yet to the area where I'm feeling major compelling arguments for value, but widened out nonetheless. Let's get right into it. This is a big week. You're probably a little more interested in some of the thoughts than you are in specific economic data, though we will get to both. Let's start with me saying this. We've been here before. The story of how we get here to this sort of market behavior is always different. It's different this time, but they say it doesn't repeat, it rhymes. Let's go back during most of our lifetimes and look at prior bear markets, what caused them, and what happened next. Let's start with the December 72 to September 74. The S&P went down 48%, got down to single-digit valuation multiples. This was caused by the OPEC oil embargo, which led to a quadrupling of oil prices. So we had high inflation without growth, or stagflation. We had loose monetary policy, excessive government spending resulting from the Vietnam War. And, of course, we had the political scandal. All of these things conspired and saw the S&P drop 48% during that period. Now, did you lose 48%? Well, I was in the second grade, and I don't think I had any investments at the time. But I can tell you that I didn't invest exactly on this day, right? 1/11 of 73. And I didn't sell exactly on this day, 10/3 of 74. And if I had been an investor, I wouldn't have been 100% in equities. So we get caught up sometimes in the emotion of these market declines, but let's really think about, if you were a long-term investor, you started maybe in the 60s, you invested here and here and here and here and so forth, and it goes on and on. Let's take a look at the next one, January 1980 to March 1980, a very rapid 17% decline in equity prices is measured by the S&P 500. Does this look familiar? There was a big shock. This time around, it's the tariff shock, but back in 1980, it was the Volcker shock. Fed Chairman Paul Volcker raised interest rates very, very aggressively to try to whip inflation now, as President Ford had called it. There were significant fears of a recession, sounds familiar. Monetary tightening. Here we have a Fed that's actually been easing by cutting rates, but they're on a pause, and we can call it a tighten. And another big oil price shock. The Iranian Revolution of '79, oil prices spiked, and that added to the inflationary pressure. We move forward to 1987, September of 1987. I was an intern that year at Dean Witter, and it was my first day on the job. And the market went down about 34%. I think it was 23 in that one day, but the total decline was 34% or so. It was largely attributed to program trading, selling begetting more selling. The program, hey, the market's going down, sell more, and it just sort of spiraled out of control. Markets were thought to be overvalued and high valuation. That's similar to today. Markets were highly valued at the beginning of the year. People worried about rising interest rates and inflation still, and the market just turned into panic, not just the program trading, but then overall panic of people. But when you look at something like this, the crash of '87, again, the pattern looks familiar. And then you see stabilization, took a couple, 3 months, and then slow but steady climb back out. January of 2020, of 2000, and to September of 2001. This was the bursting of the excessive valuation of the NASDAQ, the dot-com bubble. The S&P declined 36%. And, we're looking at a S&P in the 5,500 level now, right? Go back to 2001, we were below 1,000 on the S&P. Then that was all exacerbated by the September 11th attacks, and all of this added, this geopolitical shock added to the already tough economic situation. What each of these has in common is they would have turned out to be a really good opportunity to buy equities for long-term investors. We move forward, and we had the global financial crisis, 2007 to 2008, 56% decline in the S&P 500. Housing market collapsed. Lehman Brothers, every financial institution in America insolvent, no credit available, massive amounts of derivative exposure. What happened here? Same kind of thing. Market began to recover actually quite quickly. And so if investors had the foresight to, let's say, rebalance, perhaps the courage to add to a portfolio, these decisions during these periods turned out to be the decisions that would have added the most value or alpha to a portfolio over time. But wait, there's more. Now we have the 2020 COVID crash. 34% decline in the S&P 500 virtually overnight. The COVID pandemic led to a global economic shutdown, collapse of the world's supply chains, panic selling, fear of a severe global recession, and oil price war happened at the same time as oil prices collapsed. But again, where there was selling and there was panic selling, if someone had rebalanced a few times, or maybe added to their equity portfolios. You can see this, the S&P down around 2,200, and sure enough, fast forward a couple of years later, and you're looking at 4,100. Well, that brings us to today. Through Friday, and this morning, we're up and down a little bit. It's Monday morning. We're down 17.5% from a very high valuation, from a peak, on a geopolitical concern about the implementation of tariffs. Tariff Liberation Day did not go well for the administration. They imposed sweeping tariffs, 10% on all imports, and as much as 54% on China, and that triggered fears of a global trade war. Inflationary fears, retaliation by China was announced over the weekend. The market went into a very sharp 2-day sell-off, dropping 4,000 Dow points. JP Morgan over the weekend put out a note saying we think there's now a 60% chance of the U.S. entering recession this year. And analysts had already, as I've talked about this, been cutting their forecast due to the tariff impact and the economic slowdown that they see resulting from this. So go back. Where will this be a year from now? Will it be lower? Will it go lower from here? Nobody knows for sure. We don't know what the implementation will be of this. But I do know in all of the other times we've had severe, sharp sell-offs, we have both recovered and gone on to new heights, because this was an all-time high. This sort of illustrates the value of being in a balanced account. Whether you're 70-30 or 60-40 or 40-60, bonds are up, bonds are catching a bid, equities are down, and I believe temporarily down as the world adjusts to this new reality. And if you've been following the podcast, you know I've been calling for this to happen ever since the election back in November. Let's get to last week's economic data. The Chicago PMI rose a little bit but remained in contraction territory, 47.6. New orders were up and employment was up. We'll take it. The big national readings from S&P and ISM, S&P Global fell to 50.2, above estimates, still in expansive territory, but barely so. ISM, however, fell below 50, below the expansive range to 49. New orders fell, production fell, and employment fell. Not too good, but this is, again, we're sort of in this transition period. Construction spending gained 0.7. That was more than double the consensus estimate of economists reporting on Bloomberg. Private spending gained 0.9, after the weather-related fall in January. We got the job openings report, or JOLTS, fell just a little bit, 7.56 million. That's still more job openings than unemployed in the country. A huge surge in auto sales. This isn't sudden, love of buying new autos. This is, if I was thinking about buying a new car, maybe I'll do it ahead of the tariffs that are going to be put on, that are being put on right now. And so total auto sales, which included foreign, came in at 17.8 million, well above the estimate of 16.2. Factory orders rose a little bit more than expected. Transportation, backing out transportation, they rose 0.4%. And here is a massive, really 3 months in a row of trade deficit. It came in at 123 billion, right around in line with the estimate there. Exports up 2.9, imports declined a little bit, but were very, very elevated as importers tried to get ahead of the tariffs, the Trump administration. We then have the services PMIs from S&P Global and ISM. Remember, services is a much bigger portion of the U.S. economy, about 85%. And here, the S&P Global number rose from 51 to 54.4. That was a little bit above expectations. That's a solid number. The ISM number, not as good, but good, expansion, fell to 50.8. That was below the 52.9 estimate. New orders fell, but business activity rose. Employment, unfortunately, fell into contraction. And regular weekly initial claims for unemployment came in at 219,000. That's just a really good number. It's a low number. It's helping with all the other uncertainty we have that the labor market is staying strong. Continuing claims, though, broke through that 1.9 barrier. We have been in this 1.7, 1.8 for an extended period of time. We're going to have to watch that because we don't want to see that creeping up closer to 2 million or above. That will be a signal that we have an issue with the Fed's mandate for full employment. We got the twin jobs reports, ADP, payrolls, they say payrolls grew 155,000. That was above expectations. They revised February a little bit higher from 77 to 84,000. Finally, the Bureau of Labor Statistics report says that we added 228,000. That was a big gain, really big gain in March on top of 117 in February. However, the number of people participating in the labor force grew, and therefore the unemployment rate ticked a little higher from 4.1 to 4.2%. It's a light week for economic data, but it's an important week. One of the important things is the Fed FOMC March minutes will be out on Wednesday. Small business optimism on Tuesday. Remember, that was the biggest surge ever after the election. That's probably going to moderate given the tariff situation and the market situation. But CPI, Consumer Price Index, and PPI, Producer Price Index, are Thursday and Friday, respectively. These are important because the Fed, everybody wants the Fed to cut rates, but the Fed really can't cut rates as long as they have full employment. They still do. And if they don't have price stability, and we don't have price stability, So if they get some relief from CPI and PPI, you could see the odds of a Fed rate cut really go higher. I don't expect that relief to come, but this is what the market's going to be looking at. Okay, thanks for tuning in, everybody. As always, here at Slaying Bulls and Bears, I try to make the complex and complicated and simple and sensible. Available on all the podcast formats, but most importantly on the YouTube, you get the video with the charts and the graphs. Thank you for tuning in. I'll see you again in 1 week.